Welcome to our webcast on how traditional financial institutions enter the cryptocurrency market. Cryptocurrencies are getting increasingly important. This makes the access to those digital assets critical for all financial institutions. However, many firms face challenges to diversify their portfolio towards crypto due to uncertainty in compliance, regulation, and security. We're here today to discuss those challenges. Just before we start, a couple of notes on the housekeeping. We're abiding to Chatham House rules for this webcast, so please do not quote the speakers or reference the webcast without written permission from both the speakers and the organizer, which is Eurex. And we always welcome questions from the audience. There have been already a couple upfront asked at registration to this webcast. Please just post your questions via the chat function on your control panel at any time. We'll either tackle them at the very end or in the Q&A session, or if they fit in between, we'll just pick them up whilst the webcast is running. The webcast is being recorded and the recording will be made available to you soon after the live presentation. Of course, doesn't mean that you need to switch off now, but in case you've got colleagues or clients who are interested in the content, just feel free to forward it. Then it will be posted in the LinkedIn channel and you'll receive it also with your confirmation email. Please, in case you experience any issue in terms of performance or your video connection, make sure to just close other browsers or open applications to optimize your viewing experience. And for the mobile phone app users today, please note that you can change between video and those slides here, just swiping left or right. There are also some poll questions for you today, which will appear on your screen, so you can vote whilst they're up. And I'd like to thank you all for joining today. And if you don't want to miss any further webcast or event, just make sure to subscribe at eurex.com/subscribe. So turning back to the topic on how traditional financial institutions enter the cryptocurrency market, we've invited today to discuss Bradley Duke, CEO and co-founder from ETC Group. Hi there. Darren Jordan, Managing Director from BitGo. Hi, Darren.
Hi, everyone. Thank you for inviting me.
Equity and Index Sales, Eurex.
Hello, everyone.
And Sasha Zamrov, Product Design from Eurex as well.
Hello. Good morning. Good afternoon.
So thanks to you all for joining today. And in order to kick off with, for you guys, the audience, a poll question. Just to evaluate a bit the audience and your take on cryptocurrencies. If we just pull up that poll question right now, which asks you if you're currently trading or offering trading or are currently invested already in cryptocurrencies, with the options A, yes, we do trade, offer trading or invest already in crypto, B, no, or C, interested, we're open for future activity in the crypto space. Please vote now, and that we've got some results coming in soon. Just either vote on your desktop or if you're on the app, I think you can literally just click on it. So I don't see the results yet on the screen, but here I can see 51%, yes, here we are, already active in the space, 17% not active in the space, and 23% on the way to getting active in the crypto space. Just looking at that picture, first question to Serbi. What's the overall size of the market, and especially now with literally news every other week or even day, what are the current trends in the crypto space and what do you expect still for 2021?
Oh, that's a good question, especially after this poll, I would say. And before I begin to answer that, I would say the 51% result is brilliant that they already are. So you can already see the size of the market. But I would rather say this has been a big change in the past 1 year, which the adoption has increased more and more. That being said, I think there's almost now about 2 trillion investment digital assets, where only 900 billion belongs to Bitcoin, which used to be the dominant currency, which started it all. And now you have so many more. And although it still leads the market cap, With that being said, you're talking about news. We heard Mastercard's announcement. We heard Tesla again using the payment system. We hear so many new things, institutions, big banks adopting the currency. So it's just a matter of size and time, that how big it is and where it goes further and further. Now countries are investing more time, I would say, in regulating it, learning more about it. And so 51% out of our lot said that they are already investing or trading. There were 23% who are interested in doing so as well. This, from my perspective or the exchange's perspective, reflects quite a good sum where it's going. Keeping in mind that blockchain, crypto is just a part of it, but blockchain is the bigger part, wherein you see, decentralized apps, you see stable coins, you see central banks now rolling out their own currency instead of national currency based on the blockchain itself. You see NFTs where the fans can directly intermingle or directly get in touch with the celebrities. So this is a big deal now. And of course, it has been with respect to headwinds. For example, China's crackdown on crypto did make a shock, and we expected that maybe it was going to do something to the market, but it did not. The flow just went elsewhere. So the market seems to be very resilient, growing with it. And also the ETF approval in the US, which was not the first ETF of its kind. The first one, I would say, was in 2017, very much in Europe, but still it does show that one of the leading countries embracing it as compared to deviating. So I hope that answers your question and gives a good reflection of
looking back at the survey and your at the frontline sales and touch with many customers, what's the usual feedback you get from traditional investors approaching that asset class?
I would categorize in two categories rather. One are the ones who've already been very proactive. You see a lot of HFT firms, a lot of prop firms who've already taken the leash, and the other crypto natives who've been active since as early as 2017, 2013 rather, and they're very big. The other is the more traditional institutional side. They have been, I've seen the change or the viewpoint in the past couple of months itself, from completely saying no, and we're not going to enter, to embracing it further. Now the question becomes rather that how can we invest? How do we interact with it? Is this Bitcoin the only thing? What else is out there in the market? What is blockchain now? So there seems to be a better understanding, and particularly with our product, which we'll get into further because we have all the components of our product here and the people representing it. With that also, people have been much more embracing. It's more on the educational front, and I would say I really have to thank the banks here, like institutional. After the last primer on cryptos and digital assets by Bank of America, you see now almost everyone adopting it. So it's rather in the phase where we expect another 6 to 8 months that people will pick it up more and more. And they're looking at ways, especially derivatives have become now more popular. You see a lot of the firms which were active on unregulated exchanges now trying to get more regulated, because the industry-wide itself, they want regulation. They seem to be more in mainly, they care about the end customer. They are trying to do something different here. And here as an exchange, that's what we're providing them. So the short answer is there's been a positive outlook towards it.
Insisting exactly a bit more on that point, as you mentioned, people are looking to see how to trade. Actually, how does the current landscape, and especially the current landscape of derivatives on crypto, look like?
The current landscape is depending on, so a few major exchanges have already launched. So needless to say, Eurex was not the first one. However, we were one of the most cleaner, neater product specification one, which we launched on 13th of September. Before that, in US, you see, we had a competitor already launched something which is now much more retail driven. So to answer your question, it depends a lot in the area the product is in. There have been a few futures which are trading. Ours is a very vanilla future on a very liquid underlying. And when I say vanilla, it's a very easy way to set up. with us if you already are connected, as well as there are options in the market, but institutionally the appetite is lower. If you talk about on the unregulated exchange, it's been a very, very innovative field. There are already various swaps, perpetual futures, which are one of the most popular in the space. And coming back to us, how we are doing it, we'll find out more what we are planning with it and how the derivative space is going to look, considering we're leading, at least hopefully in Europe.
Now, as you mentioned, Eurex has launched derivatives on an ETN and calls it the trusted path to crypto. What's driving that decision, and what's behind that sentence, the trusted path to crypto?
I'm glad you asked that question because that justifies the title of a webinar. And I'll quickly give you a brief summary of it and then let Sasha jump in because he designed the product. I think we deal primarily, we have been a trusted market. We are an exchange who people trust, we are regulated. So of course our clients wanted something which is in a very safe environment where we keep our end investors safe. And this was rather a question driven by the clients to solve a problem. We saw earlier launches from other exchanges where the issue for custody of coin itself or getting in contact with the asset itself was challenging for them. Here, our solution was to keep or create something which gives exposure to the exact price, to the volatility, to the returns in the safe environment, same infrastructure without adding something on. And here I'll probably give it to Sasha, who designed the product.
Yeah, thank you, Surbi. So yeah, adding to what Surbi has already mentioned and outlined, so we were confronted with the question we would like to make an offering for especially institutional clients here in Europe. So we chose a contract that trades in Europe, in Europe and in euros, of course. And we chose that underlying exchange traded node because it has this look-through feature to the Bitcoin itself. So by the fact that the ETN is fully secured with Bitcoin, one share essentially represents a share in a Bitcoin inventory. And that leads to a pricing that is very, very close to what the Bitcoin euro rate is. And that is, of course, for a futures that wants to be a representative futures price for an expected value of Bitcoin at expiry is an ideal instrument. And the other aspect is, of course, liquidity in the underlying exchange traded node. It trades this month 950,000 shares per day, which is one of the most and biggest, most traded and biggest exchange traded products in that space, in the ETN environment here at Xetra. And mentioning Xetra, we have an underlying that trades in a regulated market, and that makes our product so unique because futures and underlying trade in a regulated environment. Futures trade on Eurex exchange, underlying trade on Xetra exchange. Both are cleared with Eurex clearing as the central counterparty. And ultimately, shares are in custody with Clearstream Banking, a very well-known custodian for paper assets of all sorts. And that, again, allows us to have a product that is very easy to access for every client that has a connection to Deutsche Börse Group, being Xetra, being Eurex. There is no additional infrastructure to be laid out. You can trade the product as any other Eurex product, and then this is what Surbi already highlighted. So we wanted to make an offering in a product that is as easy as possible to access.
So Sasha, you've mentioned why this particular ETN has been chosen as an underlying, to which we'll get to in more detail. Just looking at the derivative contract itself, what are the basics, the product basics for the audience out there to know?
Well, the product structure is very simple, and it looks like every other futures that we have on our platform. The contract size, I think, is one of the most important aspects. So we physically deliver 1,000 shares on expiry day, we are using the 530 Xetra auction price to determine the final settlement price, and that is the price that you pay in return for receiving 1,000 shares. And this physical delivery ultimately gives an, if you want, indirect settlement into Bitcoin. So upon futures delivery, you get first of all the paper assets, which is a representation of a claim into Bitcoin. And if you have the infrastructure and the ability and the desire to handle the Bitcoin yourself, then you can turn around and redeem the ETN with the issuing company, which creates a multi-purpose vehicle. We offer the next 3 monthly expiries and the following quarterly expiry, which reflects the short-term nature of Bitcoin futures trading. When you look at other venues where Bitcoin futures or Bitcoin derivatives are offered, trading is mostly centered around the next expiry. We have half a cent price increase, which using 1,000 shares as a contract value creates a tick value of €5, which is also interesting for tick traders or for traders that used to capture like the bid-ask spread, being €5 a round trip, which is still attractive for high frequency traders. And we are open from 9 to 5:30 CET. This is, I would say, the most interesting aspect of the futures itself.
That's really where it gets really basic. But you mentioned already the liquidity of the underlying itself. Looking at the derivative contract itself, how tradable is it already right now?
So we have 2 market making firms that stream prices all day long. So from 9 o'clock to 5:30, they quote 5 contracts in the front months, which tend to be around 25 cents wide, 20 to 25 cents. This depends on the price of the underlying. So if Bitcoin goes up, the market goes a little bit wider, and vice versa. And the 5 contracts represent 5 Bitcoin, if you want. Given the 1,000 shares that we deliver into each futures, 5,000 underlying, 5 futures, 5 Bitcoin. This is the hierarchy, if you want.
And you mentioned already it's built on a proven infrastructure. So what do I need as a financial institution in order to be able to trade, to get started?
So from a technical perspective, nothing. So it's set up as a single stock future. So all clearing firms that have a link into the Eurex infrastructure will have the contract readily available. It's mainly a question of your compliance and your risk management department to sign off on your ability to hit the buy and sell buttons. And of course, for clients that are non-clearing members, being like trading firms or smaller brokerage firms, of course, you need to have your clearer allowing you to trade the contract.
And as the landscape was already mentioned, how does this future differ from other cash-settled futures?
Well, as you said, it's the settlement type. Other futures are cash settled. I mean, we have one competing future that is also physically delivered by Bitcoin, and here we have, I would say, the proof that the handling of the Bitcoin itself seems to provide, let's say, obstacles, especially for traditional financial institutions, to handle the product. The majority of institutions that I have spoke to over the last year mentioned the custody of Bitcoin, the biggest hurdle to overcome in order to get exposure. And here we have chosen an underlying which is very familiar to every single of our clients, because we use this intermediate or the paper asset representation of the Bitcoin rather than the token itself. The physical delivery, of course, is, I would say, what we do is we deliver or we enable the delivery of the Bitcoin through the back door. Through the front door, we deliver the exchange-traded note that represent the Bitcoin. And if you, as a beneficial owner of that ETN at the end of the day, if you decide you would like to have the Bitcoin, then you can turn around and approach the issuing company and redeem the Bitcoin, the exchange traded note into the very Bitcoin.
Looking now more at the ETN itself, thank you, Sasha. Bradley, as it was now mentioned already several times, would like to ask you first question: how is the ETN designed and how does it work?
Okay, so the ETN, we came up with the idea for the ETN really just to look at from the perspective of the institution. We wanted to tick all the boxes that are important to the institutional investor. You know, what are they really looking for? They want ultimately are looking for exposure to this novel asset class, and so they want something that's going to track first and foremost the price of Bitcoin faithfully. And you think this seems like a kind of a logical point to make when we're talking about products of this nature. But really, it isn't that easily achieved. We've seen, you know, famously with you know, some other products which traded at a premium or a discount to the actual price of Bitcoin itself. And so the key for BTCE, which is ETC Group's Bitcoin ETN, which is what the future Bitcoin ETN Future is based on, is fully fungible with the underlying, with the Bitcoin. And because it's fully fungible, meaning you can redeem the security and ask and get delivered the physical Bitcoin, or you know, or you can buy the security on the primary market for using Bitcoin. Because it is fully fungible with the underlying, it means that the market makers, and we have several, we have you know, there's usually typically 6 or 7 market makers who are active. There will be an arbitrage opportunity for them, and they'll be able to sell the product and buy the Bitcoin, or buy the BTC and sell the Bitcoin. And as a result, you end up, because of the fungibility, you end up with a product that really is very faithful. We've seen that it's usually between 5 and 20 basis points, the tracking error, which is extremely good. So that was one of the key features in the design of the product. And then, of course, liquidity. We understand that this is super important to the institutional investor. They want to be able to get in to a position or close out of a position without market impact. And so, you know, as I've mentioned, there are 6 or 7 market makers and APs that are involved, and we are by far the most liquid Bitcoin ETP in Europe, and regularly in the world, actually. And now with what's going on in the US, that story might change a bit. But to make sure that there's a lot of liquidity and that this is a heavily traded product, we feel that is essential to the institutional investor. Another point is that the product is 100% backed by Bitcoin, and this Bitcoin is entirely unencumbered. It doesn't do anything else. We're not lending this out to make an additional yield. These assets are just kept, you know, at BitGo and Darren's storage, institutional grade storage, always cold, and it isn't used for any other yields. It's, you know, and that's part of the ethos, you know, at ETC Group around structuring the product with investor security really front and center. And a couple of other things that we have an independent trustee, which is not actually that uncommon with this kind of product. But what is uncommon is, and actually unique to our product, is that there is also an independent administrator who has to, whenever there's a movement of crypto and securities, has to approve the transaction. They have full veto rights on any transaction, so that if for any reason there might be a mistake or even white collar crime, then this actually can't happen. The transaction can't happen unless it's according to a set of agreed rules and within the security parameters that have been defined at the outset. Yeah, so those are really the main thoughts and the main reason, the main qualities that we were looking for when we designed the BTCE.
And you had mentioned already the recent launches in the US, ProShares, and we've all read it, and gaining quickly assets just in 2 days. What's your view? What's your perspective on those recent launches?
Well, I think in Europe, there's been a lot of noise about the first Bitcoin ETF in America, and quite rightly so. I think this is a country. It's the largest investment community in the world, and there's a lot of interest in this. And there's a lot of pent-up demand, I would say, for a Bitcoin ETF. Now in Europe, the products that we have here, including BTCE, are actually not ETFs by name, but they are, for all intents and purposes, the same thing. It's really just a quirk of the UCITS laws in Europe, which prevents there's certain concentration limits on a single asset, and actually for that reason you can't really have a Bitcoin ETF in Europe by the UCITS definition of what an ETF actually is. But what we do find ourselves is in a situation where the products in Europe, which aren't called ETFs but they're called ETPs, are actually better investment vehicles than what we have found in the US. They track the price of the underlying more reliably. Certainly the BTCE product does, and also they're just better suited because they are allowing direct exposure to the underlying assets and not based on a futures contract, which is the case in the US. It's kind of a clunky way of getting of creating an ETF, but that was the only option that was available to them based on what the SEC was looking for. Having said that, the products that we have in Europe really do address the concerns that the SEC had. One of the things was that they were looking for price discovery on a regulated exchange, and we've got that listed on Xetra, on Deutsche Börse. And also they were worried about manipulation, and because of the fact that a lot of the underlying was thinly traded. As we know, this is a very heavily traded product, and actually it's become a product for BTC, has become a product for Bitcoin price discovery. The reason is that the APs who are making markets in this product, all sourcing their Bitcoin in different places. And what BTCE actually effectively is doing is becoming an aggregate price of all these various sources of Bitcoin, and has become the de facto price discovery source for Bitcoin, at least in Europe.
Looking more at the product itself, how are out and inflows managed?
Sorry, say it again, please.
How are in and outflows managed? Looking at the product itself.
Right. So the way that the classic sort of ETF or ETP model, is one of cash creation and redemption. And so an order comes in, and then the issuer will go out and actually hedge. They'll go out and buy the underlying and so there's a period of time where the securities are actually uncollateralized, and this is not the case with BTCE. Because there is in specie, there is creation and redemption in Bitcoin itself. The way it works is we actually, as an issuer, wait until we've received the Bitcoin from one of our APs. So only this process of creation can only happen through authorized participants who are regulated brokers. And so that once we've received the Bitcoin in custody, and actually at BitGo, then only at that point do we issue the securities. So the securities BTC are always 100% backed. There's always an excess of collateral or backing the security in secure custody. And redemption's the same process. We'll first receive the securities, which we'll then cancel, and only at that point will we return the Bitcoin to the authorized participant.
Okay, and as an institutional investor, can I end up in a situation where I receive Bitcoin without any intention, or where I'm supposed to receive Bitcoin?
No, there's absolutely no chance of that happening. I mean, this was by design. We know that a lot of companies, a lot of investors don't want to handle cryptocurrency at all, or are not equipped to do it, and don't ever want to be in the situation where they're obliged to receive cryptocurrency unintentionally or unwanted. So that's never the case. So there isn't a situation where anybody will be forced to take cryptocurrency.
And you've mentioned that already, thank you, but how did ETC create the structure of the product, and also what does it make really different from other products out there in the market?
Right. So I think certainly as I mentioned, the trading profile is one of I think one of the reasons why the team at Eurex selected BTC in the first place was the fact that it does dominate in terms of average daily trading volumes, and also the assets under management are significant. Today we have over $1.5 billion dollars worth of Bitcoin behind the product, or invested into BTCE. And so the trading profile was an important thing. We wanted market depth, we wanted tight spreads, and if you look at the market on Eurex, sorry, on Zitra, you'll see that BTCE frequently trades as low as below even 5 basis point spread, and is significantly tighter than the nearest competitor in terms of the how wide those spreads are. That's of course very important for the institutional trader, because this is a wide spread will contribute to the total cost, the total transaction cost of opening or closing a position, and we wanted to make sure that there was also very good market depth. Of course, players can also approach an AP and get a price made OTC. That is possible too. Yeah, so the trading profile was very important for us. And then of course, as I mentioned, security, making sure that everything was done best in class, that we have excellent custody, that we have all these checks and balances, and in the structure of the product in terms of the independent trustee and the independent administrator, and also that the company itself is set up as a bankruptcy remote structure, so that if for any reason the ETC Group stop trading, that shouldn't have an impact on any of the investors, because the trustee would at that point step in and make sure that there was the collateral, the assets being held backing the securities would be sold off, and value would be returned to the investors. Yeah, so that was extremely important for us to to make sure that the product was designed. And as I mentioned before, the assets are unencumbered; they're not lent out, and that isn't always the case. And I think if somebody is interested in opening a position in a Bitcoin ETP, they should really read the small print of the prospectus of the issuer, and to make sure that they understand the risk, because if these assets are being lent out, the risk is really unknowable by the investor.
You mentioned already custody, and to again get the audience involved, we've got another poll question looking really at the challenges we see with crypto, and here asking you in the audience, what are the main challenges you see with crypto? One, market access, so either not allowed to invest in cryptocurrencies for legal or regulatory reasons. And B, lack of clarity around regulatory environment or regulatory classification. C, unfamiliar trading and financing infrastructure. D, lack of custody solution, as mentioned, for digital aspects. So please give your perspective on it. I see the percentages already moving on my screen with a large tendency for the lack of clarity around the regulatory environment, followed by the lack of custody solution for digital assets. Don't see the results yet on the screen here. Yeah, just looking at that, 75%, a lack of clarity around regulatory environment, followed by the lack of a custody solution for digital assets, and then followed by unfamiliar trading and financing infrastructure. As mentioned, and here I would like to ask Darren joining us. We're also conducting currently a larger survey within the community at Eurex, where also, and here has been the second most prominent answer, where more than 60% of respondents actually see custody as one of the challenges. So asking you, representing BitGo, how does custody in digital assets work? How does BitGo ensure safe custody?
Yeah, and it's a great question. I mean, if you actually stand back and look at the technology, for many institutions, the concept of blockchain is still very, very new. It is very different from equities and bonds. If you look at the decentralized nature of the blockchain, we have to take a very different approach. But actually, at the same time, many components of custody is actually in line with the existing custody of products and asset classes, specifically around the fiduciary responsibility of a custodian. So BitGo has been building the plumbing for institutions since back in 2013. And part of, I guess, the challenges has always been regulation, governance, security, operational processes. They all play a really important part of securing digital assets. With regards to security itself, you know, from BitGo's perspective, removing a single point of failure, it was actually a major component of that. And back when we originally kind of launched the business, we actually pioneered the concept which we refer to as multi-sig security. Now, prior to this, and there's some players currently using what we call single sig wallets. So this is where you have a private and public cryptographic key. And ultimately, if this key gets lost, damaged, or stolen, the asset is lost as well. So when we look at kind of removing the single point of failure, what we're looking to do here is to have multiple keys that protect against single machine compromise and loss. We're also looking at multiple users to protect a single user against theft and coercion. We look at multiple institutions to protect against fraud and single storage compromise. And then actually, you think of multiple geographical regions to protect against regional failures as well. Regulation, it obviously plays an important part. So BitGo actually has multiple licenses in different jurisdictions. Governance, as I mentioned earlier, is another important part. So BitGo takes this very seriously. We have a number of independent audits, SOC audits, and actually operational processes, the importance of segregation of duty. So actually some of these concepts do align with the traditional custodial model. But actually BitGo was the first custodian of its kind to specifically be built from the ground up for digital assets, safekeeping. And if you look at into the technology, we refer to deep cold storage many times, and this is where assets are actually stored in segregated accounts. They're insured and they're secured by BitGo's multi-sig technology. So deep cold storage actually is where the key material itself is actually stored, generated offline. So these private keys are generated offline. The signing process is offline. None of the key material ever touches the internet. This, in combination with our secure facilities, actually we say secure facilities, they're referred to as physical bank vaults. So people can connect that there is a physical vault where some key material is stored, and there are multiple vaults. And there is also a technology hardware solution called HSMs. For people familiar with that, it's actually hardware security models, which is very familiar with the kind of the banking infrastructure of how they store sensitive material. It's a combination of all that together. But I mean, I think we need to step back and think, actually, security is not just based on just the technology. The actual design of the product itself has been designed to actually not allow quick speed of access to funds. So deep cold storage by design provides assurance that funds cannot be easily transferred. There has to be a rigorous process and controls applied before a transaction can be, or withdrawal can be processed. And we look at this covering different areas. So if you mentioned protection of digital keys in physical vaults, sharding of keys across multiple physical vault locations, and multiple people that must be present to unlock institutional funds. All these combined together is what makes custody unique from a technology, but at the same time, that fiduciary responsibility of a regulated legal entity with a minimum reserve requirement, holding client assets, so acting on the client's best interest. So they would be the kind of main points I would highlight.
And we've seen that partially in the poll, but what are the pain points, what your clients have, and how do you address them?
Yeah, it was interesting actually. I think on the introduction, some of those pain points were already kind of mentioned. I think we have to appreciate this is a brand new asset class for many BB people here. So a lot of the barrier really is about understanding how the underlying works. This is not just the storage, but actually nuances around how does the blockchain work and all around it. So there's a lot of education that's needed. Regulation, it comes up time and time again. Specifically, Europe is fragmented. There's no coordinated approach with regards to regulation in Europe. That being said, MiCA, which hopefully comes into play in 2024, will look to kind of harmonize that regulation across the entire EU member states. BitGo deals with that in a different way because we have multiple legal entities throughout Europe. So we have legal entities in Switzerland, as well as Germany, as well as other entities. Governance. So governance also plays a big part in kind of a barrier for some clients. Specifically, they need to do a lot of due diligence. And to be able, as a custodian, to provide independent audits is invaluable. Insurance. In an ideal world, insurance would be easier to obtain for everyone. Unfortunately, the insurance market is still very new, and yet again, that's another industry that is in the process of being educated of what digital assets involves, the storage, the whole kind of the platform there. But BitGo has obtained insurance, so that is how we've solved that solution. And then I guess we briefly touched on access, and this really plays into kind of the Bradley's product or ETC have. Access to crypto via the traditional fiat rails is still problematic. The concept of an institution that has to send fiat to an exchange, that exchange, we're talking about a crypto native exchange, most of them are unregulated. Some of the institutions' banking partners are not comfortable with this transaction. And then you fall into how to hold the asset at the end of it. So these are all challenges that the industry is working to kind of solve. And obviously custody plays a big part of that.
And Darren, you've touched briefly on that, but what are the associated risks? What's the risk of loss, destruction, or a hack?
Yeah, I mean, the consequence is actually catastrophic in the sense of here you have key material, specifically if it's single sig keys or any key material that's been exposed, copied, is potentially open to loss of assets, whether it's through fraud or simply the storage device has been destroyed or damaged. I mean, I think we've all heard here, there's some horrendous stories where your personal devices have either been lost or stolen or just mislaid. So the consequences are real, and this is a part that we need to get across, that this is very different from the traditional securities market. Therefore, it is absolutely essential that a custodian is holding, that this experienced custodian that has all the infrastructure around it can hold these assets securely on behalf of clients. By not using a custodian, you're simply exposing yourself to many risks. I think if we kind of look back at what I answered in the previous questions, I think BitGo mitigates these risks by, yet again, removing the single point of failure, forcing also on the client side a number of criteria where the clients themselves can set their own policy controls, whitelisting addresses, multiple approvers, video verifications, etc. And yet again, insurance also does play a comforting part. Specifically, insurance that's been provided by Lloyd's syndicates. It covers things like the loss of theft of private keys, insider theft, and loss of key material.
And you've mentioned already regulatory harmonization happening. What else next to that do you see ahead for custody solutions? I
think the big thing, and we briefly touched upon this a little bit, is custody at the moment is physically holding the assets on behalf of the client. The infrastructure outside the marketplace lacks the prime brokerage model in particular. And that is, this is a process which you think that it started relatively not that many years ago, and we're building out the infrastructure, not only BitGo, but all our colleagues and partners in other custodians, to building out that plumbing work to enable what we would be very familiar with in the traditional financial markets is still being kind of developed. So that kind of prime brokerage model where custodian holds the assets and you could actually trade at various venues. It's very alien to a traditional institution that they trade with an exchange or kind of crypto exchange, but that crypto exchange holds the asset. That is very alien. So that is something that we'll definitely be working on. I think we're going to see a huge, exciting move coming into DeFi. I mean, BitGo's already been heavily involved with DeFi, Wrap WBTC, that's up to 13 billion now. So BitGo is a custodian for Wrap WBTC, and our recent integration with MetaMask. And I think the next kind of, I guess, big component of that is new assets. We've been predominantly just talking about Bitcoin here. There are a huge universe of alternative protocols, layer one protocols, whether it's Ethereum, whether it's all the major large cap coins. And I think there's a need now for some diversification with digital asset space. So I think new assets and new kind of products coming in kind of concentrates on diversification.
As you mentioned the universe, asking Bradley, what do you think is ahead in the ETF/ETN space?
Well, I think there's definitely you will see a continuation of proliferation of different ETPs that are single asset based. Of course, further development and sophistication in ETPs that represent an index as well, or a basket of assets. And I think we'll start to see more yield-bearing products as well as this space becomes more sophisticated and the investors become more sophisticated. There's definitely an appetite for ETPs where there's a coupon or a yield associated, maybe related to DeFi, maybe related to staking, but there's opportunity there for sure.
And Sobi, looking at the derivative space, what do you think is ahead? As you mentioned, also the landscape at the beginning.
I think that'll be like just continuing more in the regulated space and derivatives. I would say that there's a large probability we'll see more innovative products, particularly more crypto index or indices. That is something which a lot of people have been trying to get on with, because we've seen a lot of Bitcoin index already. ETF, there's been so much focus, but Ethereum, Bitcoin are just now, I think, over 60% of market share. So we expect more crypto index and options, of course. With ETF's launch, we would expect there to be a larger participation and an ability to price options in the regulated, rather institutional client, because currently the volume is not there because of the absence of certain other products which haven't allowed it to do so. And hoping more innovative products such as variance swaps, etc., on regulated exchanges.
Looking at the first questions which we received here via the Q&A functionality, still have the chance to ask some questions, but maybe taking the first one here. I think, yeah, probably going to Bradley, if just asking, is it UCITS compliant? I think that alludes to the underlying.
Yeah, so BTCE, I would just stress that investors shouldn't rely on our own analysis of UCITS rules, and they should make their own assessment before investing. But certainly looking at ESMA's Q&A guidelines for UCITS ETFs. ETC certainly is UCITS eligible if you go through all the major points: transferability, no physical settlement, purchase and sale on exchange, no embedded derivative. I think that's all of them. Or direct subscription by authorized participants only, I think is the last point. It ticks all the boxes on that, and based on our assessment, it is BTCE is UCITS eligible.
Thank you. Then one question here: will default or guarantee funds be segregated so that crypto-related contracts have their own carve-out from the total? Looking at that, probably Sasha best suited to answer that.
Yeah, thank you. So the Bitcoin ETN futures, they are part of the overall default fund, which makes it automatically accessible to all clearing members that are part of our Eurex clearing default fund. What we have done in order to, let's say, make special reservations for this product is we have created a segregated liquidation group. And currently, this liquidation group is for cryptocurrency derivatives, and the Bitcoin ETN Future being the first of this kind. So it sits there on its own now, or yet. And that makes sure that in the case of a clearing member defaulting, only other clearing members that do have positions in Bitcoin ETN futures will be called into the default auction and bid for the portfolio. So clearing members that do not have any positions in that product will not be asked to participate in the default auction.
Thank you, Sasha. Then one question here on onboarding. How long does it take to onboard to be then finally able to trade? Sasha or Sobi, I guess.
Well, I mean, from the onboarding process, if you are a member to Eurex exchange, then you would approach your clearing firm and ask to support the product to kind of provide the product approval. From a technical perspective, there's nothing to be done. So the product comes with the data feed or the instrument data feed every morning. So it's readily available in your basement, and you just have to get the risk management compliance approvals of either internally or from your clearing firm to be able to trade the product.
But and to add to that, I would just like to reiterate what Darren had spoken about. The education is the part which takes the longest, actually, because we see a lot of client interest who would like to trade the product, who would like to do it, but it takes about anywhere between 6 to 1 year for the education for the client to be completed about the entire segment. So that's another part of it, like from your exchange as well, the educating the existing clients at how they can and what the crypto product is all about.
Then one more question here, looking, I guess, rather at the underlying, what the volume split roughly between institutional and retail clients is, or I guess no precise percentages expected here, but maybe giving also in comparison to the US a perspective on that could be interesting.
Well, this is a very challenging question to answer because actually, as an issuer, we don't know. So the product gets traded on exchange or on an OTC market with the authorized participants. Those are anonymous transactions, and we only face off against the authorized participants. Those are who our clients are. So we can only just see creation and redemption orders coming in. And occasionally we do see quite frequently, due diligence requests from large institutions who are asking all sorts of questions about the way we set up, and that gives us an indication that there's institutional interest, or and then the other thing that you would look at is really some big trades or big movements on a particular day, which would suggest that there is an institution behind it. But crypto, as we know, is a retail grassroots in its origin. But as every week goes by, we see it moving up sort of the food chain, if you will, from to private banks, to family offices, wealth managers, and then onto hedge funds, and then larger institutions, and we know that they're in that they're trading now. But there's still quite a few who are more conservative by nature, who still sort of waiting to sort of cut their teeth. But it's a great to have a product, and an innovative product from Eurex, like this Bitcoin ETN Futures. It also allows for a whole other class of investor into the asset class as well.
Then maybe one last question, as there's quite many getting in here. One looking at the fact that currently there's a lot of volatility itself of cryptocurrencies, and a question, and I guess there's no yes/no answer or easy answer to that. If that will change now with more traditional institutions adopting it, I don't know if someone is suited to give a brief answer on that, or just perspective and a view.
Go for it.
I'll just very quickly. I think you ended on the right note. I don't know if anyone's perfectly suited to answer, but from an exchange perspective, we do see more resilience as it's been growing. If you're particularly talking about Bitcoin, so if you see the fall is never now lower than before. Before you could see when it touched the 20,000, it fell back to 6,000 or 4,000. However, now when it falls, it is within a smaller range. So as we see more and more minted, because most of the Bitcoins are now mined, and there's short, so we expect it to be more resilient and the volatility to go down just by pure mathematical foundation. However, that is in kind of an educated guess, but no one knows. Bradley, what do you think?
Well, yeah, I mean, what we've been seeing is definitely more, of the, upside volatility and less of the downside. And this is actually what you're saying, what you're talking about. Yeah, more support when the price starts to fall. For that very reason, there are people who are holding it and who want to hold it and have got a very long-term view. But having said that, volatility is very hard to predict. We've seen it, and it's not unique either to cryptocurrency, as we saw with crude oil this last year, and so it's just a part of trading, and yeah, it's certainly not for the faint-hearted, and it's one thing that needs to be taken into consideration when making an investment decision.
I think there's a definite shift to more institutional players. The macro picture this year has just been phenomenal. COVID actually played in the hands of the store of value, the quantitative easing, the printing of money that we've seen with governments. So actually, what we're seeing is significant longer-term holders. So actually, the volatility will probably be slightly more skewed on the upside, on the rarity. But yeah, as Bradley said, it's incredibly difficult. This is a brand new asset class, so clearly there will be times when liquidity pushes volatility either way. But actually, we're more bullish than ever with the macro picture as well.
I mean, one aspect that could come in also into the question of increasing or decreasing volatility is, I mean, to the point that the more clients and users come into the market, the more likely is it when they are sellers that they are buyers to come in and buy the dip or sell the upside rally. And I think one important aspect is also the options. So if once options are part of the market, then you have gamma hedgers, and gamma hedgers normally tend to be the buyers when markets go down, or be the sellers when markets go up. and then that makes, let's say, that gives it a little bit of a caution in terms of price moves. And we see this many times, especially here in the equity index and single name space.
That's a good point.
Yes, in regards to the time, as we're exactly on point, basically, maybe just one very brief to answer question to Sasha. So as a financial institution, circling back to the core question of the webinar today. So if I'm a traditional financial institution and want to take the next steps, what are the next steps to take? What do I need to do to get active?
Well, you approach your clearing broker to support the product, and then depending on the way you access the market, so either you submit or you give your broker an order that he or she executes on your behalf on our platform, or you have direct market access and you submit your orders yourself and execute in our order book. It's as simple as that.
That sounds indeed simple. Then I see there were many more questions. So in case you've got more questions which you would like to have answered by Bradley, Darren, Serbi, or Sasha, feel free to send them as a private message, or in case also you want to get in touch with one of them, we're happy to facilitate that. So just drop us a private message here in the chat. And with that, I would like to take the occasion to thank to the audience for dialing in today, and especially thanking to our speakers here, to Bradley, Darren, Serbi, and Sasha. Thanks for your attention. As mentioned, in case you don't want to miss any further invite, just eurex.com/subscribe. And with that, again, thank you all. Have a good rest of the day. Goodbye.
Bye-bye.
Thank you so much.
Bye-bye, everyone.